Investors love the Parag Parekh Flexi-cap fund. It has a fabulous performance over the long term. It ranks second if you look at 10-year returns. But the fund doesn't seem very attractive when you check its short-term returns. The fund doesn't feature in the top 10 based on 1-year returns. And if you look at 3-year returns, it's 8th or 9th. So what's the fund's performance secret over the long term? If you think it had great returns in the past and now it has lost its charm because of size, you could be wrong. Historically, there have been many occasions when the fund underperformed when markets did well. However, when markets fell, Parag Parekh Flexi-cap fund protected the downside, and that has helped its long-term performance. Hello and welcome to ET Money's YouTube channel. In this video, we will analyze why funds that fall less fare better than those with high short-term returns. We will also discuss more funds like Parag Parekh Flexi-cap fund, which are great long-term performers as they have solid downside protection when markets fall. For this, we will examine 4 mutual fund categories: large and mid-cap funds, flexi-caps, mid-caps and small caps. So if you want to shortlist good long-term performers, watch this video till the end. But before we proceed, a quick update. You are watching this video on our English YouTube channel. हमारा एक हिंदी चैनल भी है जहाँ पे सारी वीडियोस आप हिंदी में देख सकते हैं. And if you are, or if you know someone interested in understanding the basics of finance, then we have a channel called 5 Minutes Finance. I've attached links to both channels in the description section below, so do check them out. Okay, let's first understand why funds that fall less do well in the long run. We often opt for funds that have done well in the past 1, 2 or 3 years. Obviously, we want to be part of the funds that are doing best in the current market. However, such a strategy may not pay off if you're a long-term investor. So instead of focusing on funds that have outperformed the benchmark in the recent years, look for schemes offering fantastic downside protection. Let's understand this by comparing 2 funds. We will examine the performance of Edelweiss Flexi-cap and Parag Parekh just to highlight the point. Now, it doesn't mean Edelweiss is an underperformer. Now, we compared Edelweiss Flexi-cap fund's monthly returns and that of Nifty 500 since 2018. So, we had data for over 80 months. Then, we looked at how well the fund performed when Nifty 500 had positive and negative monthly returns. This will show the fund's ability to participate in rallies and protect the downside during corrections. So how did the fund perform when Nifty 500 had positive returns? Here, the fund's upside was better than the benchmark in 52% of the months. This shows that the fund has a good upside capture ratio. We took Edelweiss Flexi-cap fund as an example because it has one of the best upside ratios in the Flexi-cap fund category. Next, we did the same exercise for months when Nifty 500 had negative returns. Here, the fund's downside was better in 60% of the months. Now, even though this downside protection looks good, it is not very impressive compared to peers. The category's average downside protection is around 66%. Now, we did the same analysis for Parag Parekh Flexi-cap fund. The upside was not as good as Edelweiss's. Parag Parekh performed better than the benchmark in just 42% of the months. However, its downside protection was 80%. This is one of the best in the category. So, the Edelweiss Flexi-cap fund had a really good upside capture, but its downside protection ratio is not that impressive. On the other hand, the Parag Parekh Flexi-cap fund has a good downside protection ratio, but its upside capture is average. Now take a look at the long-term performance of these funds. We examined their 3-year rolling returns from January 2018 as we wanted to compare funds post the recategorization in 2017. That's when most funds became truly comparable. The average rolling returns of Parag Parekh Flexi-cap fund during the period was 24.18%, while that of Edelweiss Flexi-cap was 19.8%. So despite a higher upside capture ratio, the Edelweiss Flexi-cap fund underperformed the Parag Parekh Flexi-cap fund. This shows that downside protection is crucial when it comes to long-term performance. Now we did the same analysis for 4 mutual fund categories to see if the trend persists. These include small cap, mid cap, flexi cap and large and mid cap funds. Now we did not look at large cap funds as most of these funds have underperformed their benchmarks in the long term. Now we found an interesting trend. The average downside protection of the funds that outperformed their benchmark was better than those of underperformance in all 4 categories. This is similar to what we saw in the case of Edelweiss and Parag Parekh Flexi-cap funds. We noticed one more trend. In the case of mid-cap and flexi-cap funds, the outperformers not only had better downside protection but also had better upside capture ratios. However, outperformers in the large and mid cap and small cap categories had better downside protection. However, their upside capture ratio was not better than underperformers. Overall, the data shows that even with a moderate upside capture ratio, if a fund can protect its gains during market downturns, it is likely to do better over the long term. Now, let's look at which funds have the better downside protection for different mutual fund categories. Let's start with small cap funds and see which funds made the cut. Between January 1, 2018 and November 5, 2024, the Nifty Small Cap 250 TRI delivered an average 3-year rolling returns of 24.67%. Of the 23 small cap funds that had the required data, 21 beat this return. In terms of downside protection, the top 3 funds are Tata Small Cap, Axis Small Cap, and Nippon India Small Cap Fund. Now, Tata Small Cap did better than the Nifty Small Cap 250 TRI in 92% of 1-month periods when Nifty Small Cap 250 TRI gave a negative return. Axis did better in 91% of the cases and Nippon in 85%. An interesting thing to note about these funds is their upside participation ratios are below 50%. This means that in more than half the cases, they couldn't keep pace with the index when it gave positive returns. Despite this, all 3 have outperformed the benchmark, and that too by a good margin. So it's likely their outperformance is due to their downside protection capabilities. Among the small cap outperformers, the average downside protection ratio is 79%, while the average upside participation ratio is just 36%. Next, let's look at the mid cap funds. The average 3-year rolling returns of the Nifty Midcap 150 TRI stand at 24.54% per annum. Of the 25 midcap funds with the required data, only 12 could beat the benchmark. Among these, the top 3 funds with the best downside protection ratios are Mahindra Manulife Midcap, HDFC Midcap Opportunities, and Kotak Emerging Equities. Mahindra Manulife Midcap and HDFC Midcap Opportunities both have a downside protection ratio of 83%. Kotak Emerging Equities downside protection is 80%. Each of them has a below 50% upside participation ratio too. Among the outperformers in the mid-cap category, the average downside protection ratio is 72% and the average upside participation ratio is 43%. So like small caps and mid-caps too, downside protection appears to be key to outperformance rather than upside participation. Okay, let's talk about large and mid-cap funds now. The Nifty Large Midcap 250 TRI delivered 20.74% returns in terms of average 3-year rolling returns. Of the 26 large and midcap funds with the required data, only 13 managed to return more than this. The toppers in terms of downside protection are Kotak Equity Opportunities Fund, Union Large and Midcap Fund, and ICICI Prudential Large and Midcap Fund. Kotak Equity Opportunities downside protection is the highest at 86%. All 3 funds have less than 50% upside participation ratio too. In the large and mid-cap category, the average downside protection of the outperformers is 66% and the average upside participation is 47%. Here again, downside protection is key to outperformance. Finally, let's take a look at Flexi-cap funds too. The Nifty 500 TRI has an average 3-year rolling returns of 18.53%. Of the 27 Flexi-cap funds with the available data, about 15 funds outperform the index. The Parag Parikh Flexi-cap Fund, JM Flexi-cap Fund, and Canara Robeco Flexi-cap Fund are the toppers in terms of downside protection. All 3 funds have a downside protection of 80%. If we look at the entire category numbers, then among the outperformers, the average downside protection ratio is 66%. And the average upside participation is 47%. Okay, if we combine the findings from our analysis of the 4 categories, one thing is clear. Strong downside protection is a common trait among most long-term outperformers. This is why you should prioritize a fund's downside protection capabilities when building your portfolio. Don't get swayed by flashy returns during bull markets. If a fund rises quickly but falls just as fast, your overall returns may be disappointing. Sticking to funds with solid downside protection is a more reliable way to build wealth while maintaining peace of mind. Of course, there are exceptions. Some funds may outperform in the long term despite weak downside protection, while others may underperform even with impressive ratios. The funds discussed in this video are not investment recommendations. The goal is to emphasize the importance of downside protection and highlight which funds excel in this area. Always do your own research before investing in any of the funds mentioned. And that's all we had for you today. I hope you found this video useful, and if you did, please don't forget to share it with your friends and family. I'll be back soon with another video. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.